Here is a number that should stop you in your tracks. $22 billion. That is what one of the world's most powerful energy companies just committed to a single country in a single transaction. Not a country flush with cheap production. Not a region that has dominated headlines for decades. Canada. And the reason this matters not just for Canada, but for every country that buys energy, every government trying to secure supply, and every investor watching where the big money is flowing, is that this deal is not really about one company acquiring another. It is about a fundamental restructuring of where the world is going to get its energy for the next 30 years. Welcome to Global Sketch. If this is your first time here, hit subscribe right now because this channel maps out the forces reshaping the global economy before the mainstream catches up. Today we are breaking down the biggest energy story of 2026, and it is moving faster than almost anyone expected. On April 27, 2026, Shell announced it had signed a definitive agreement to acquire Calgary-based ARC Resources in a deal valued at approximately $22 billion Canadian dollars, including assumed net debt, which translates to roughly $16.4 billion US dollars. Under the terms of the arrangement, ARC shareholders receive $8.20 Canadian in cash plus 0.40247 Shell shares for every share they own, a price of approximately $32.80 per share, representing a 20% premium over ARC's 30-day volume-weighted average price. Both boards approved the deal unanimously. Closing is expected in the second half of 2026, pending shareholder, regulatory, and court approvals. Now, before we get into why this deal is much bigger than it looks, you need to understand what kind of company Shell has become over the past decade, because the contrast with where Shell is going now is exactly what makes this story so significant. Roughly a decade ago, Shell was moving in the opposite direction inside Canada. The company was divesting large portions of its oil sands exposure, retreating from higher cost, higher emission upstream production as global energy majors reposition toward lower carbon assets and long-term decarbonization strategies. At the time, many analysts read that exit as permanent. Shell was pulling back. Canada was yesterday's story. The future was somewhere else. But here is what changed. Global energy markets did not follow the script that was written in boardrooms between 2015 and 2021. The world still needs enormous quantities of natural gas. Asia's demand has not slowed down. Europe's energy crisis proved that supply security is not a policy preference. It is an economic and national security imperative. And the Middle East, which has supplied a significant share of global oil and gas for generations, has become dramatically less reliable as a source of stable long-term supply because of the ongoing conflict involving Iran. That is the context in which Shell CEO Wael Sawan stood up and said, in plain language, that this acquisition establishes Canada as a heartland for Shell, not a growth market, not a secondary asset, a heartland. So what exactly is Shell buying? The answer to that question is where the real scale of this deal becomes visible. ARC Resources is the largest pure-play producer in the Montney Formation, one of the most productive natural gas and liquids-rich shale basins in North America, stretching through northeastern British Columbia and northwestern Alberta. ARC reported production of approximately 374,000 barrels of oil equivalent per day before royalties. Around 58% of that output is natural gas, with the remaining 42% consisting of crude oil and high-value natural gas liquids including propane and butane. More importantly, ARC controls over 1.5 million net acres across the Montney. Shell already owns roughly 440,000 net acres through its existing Ground Birch and Gold Creek assets in the region. Combine those two positions and you get an integrated footprint exceeding 1.9 million net acres, one of the largest single-operator land positions anywhere in the entire Montney Basin, with a resource base capable of supporting decades of production growth. The financial numbers attached to this are equally striking. Shell says the acquisition adds approximately 370,000 barrels of oil equivalent per day to its portfolio immediately, along with roughly 2 billion barrels of proved and probable reserves. The company projects that this deal generates annual free cash flow of around $1.5 billion through the rest of this decade and approximately $2 billion per year after 2030. Within the first year of closing, Shell expects synergies of at least $250 million annually, driven by shared infrastructure, reduced operating costs, and the ability to manage adjacent land positions as one integrated system. Put that in perspective. Throughout all of 2025, Shell spent roughly $2 billion on acquisitions that collectively added around 40,000 barrels per day of new production. This single transaction adds approximately 370,000 barrels per day, nearly 10 times that amount. Shell also says the deal accelerates its projected production growth rate from around 1% to approximately 4% compared to 2025 levels. For a company the size of Shell, moving growth expectations by several percentage points is not a minor adjustment. It is a statement of intent about where management sees the biggest value opportunity over the next decade. Enverus analyst Andrew Dittmer described the acquisition as a firm confirmation of the Montney's competitive position in the global gas landscape, noting that the deal also elevates Shell from the 7th largest Montney producer to 2nd place overall, behind only Denver-based Ovintiv. But the ARC deal only fully makes sense when you understand what is happening at the other end of the pipeline. Because Shell is not just buying gas reserves, it is locking in feedstock for what could become one of the most strategically important export corridors in the world. Shell holds a 40% stake in LNG Canada, the liquefied natural gas export terminal at Kitimat, British Columbia, that completed Phase 1 construction in 2025 at a total cost of approximately $40 billion and has already shipped more than 60 cargoes to Asian markets. The facility operates with a crucial geographic advantage. Its location on Canada's Pacific coast gives it a shipping route to Asia that is roughly 50% shorter than routes from the U.S. Gulf of Mexico, bypassing the Panama Canal entirely. That shorter route means lower shipping costs and faster delivery times, which matter significantly in competitive global LNG markets. The big question that has surrounded LNG Canada since before Phase 1 was built is whether Phase 2A, potential doubling of export capacity from 14 million tons per year to 28 million tons per year, would ever get a final investment decision. That question is now moving rapidly toward an answer. In May 2026, the federal and provincial governments reached a cooperative investment agreement specifically designed to support a Phase 2 final investment decision. Energy Minister Tim Hodgson told industry participants at Sierra Week in Houston that a decision is likely to come before the end of 2026 and that LNG Canada Phase 2 has been formally designated a project of national interest under Ottawa's Building Canada Act. The joint venture partners Shell, Petronas, PetroChina, Mitsubishi Corporation, and Kogas approved capital to advance final work scopes for the expansion. TC Energy's Coastal GasLink pipeline, which feeds the terminal, has already signed commercial agreements to advance its own Phase 2 expansion. What the ARC acquisition does in this context is remove one of the biggest remaining uncertainties in the Phase 2 equation. Instead of relying on complex supply negotiations with multiple independent producers, Shell would now control a massive, contiguous gas resource position in the Montney specifically designed to feed LNG Canada at scale. The gas fields and the export terminal would be managed by the same company under one integrated strategy. That kind of vertical integration dramatically changes the risk calculus for a multi-decade, multi-billion-dollar expansion commitment. TD Cowen analyst Aaron Bilkoski said it plainly: LNG Canada is the driving economic logic behind the ARC acquisition, And a final investment decision on Phase 2 will be critical to evaluating the deal's ultimate upside. The energy story building around Canada does not stop at Shell and LNG Canada. Several parallel developments, all happening within weeks of each other, tell you that something structural is shifting across the entire sector. On April 24, 2026, the federal government approved Enbridge's $4 billion Sunrise expansion program in British Columbia, the first major pipeline project green-lit by Prime Minister Mark Carney's government. The expansion adds up to 300 million cubic feet per day of additional transportation capacity to Enbridge's West Coast pipeline system, which moves gas from northeastern BC and northwestern Alberta south toward the coast. Construction is scheduled to begin in July 2026. The expanded network is designed to serve LNG export facilities, including Woodfibre LNG near Squamish, which is on track for completion by late 2027. Enbridge CEO Greg Ebel described the project plainly. Demand for North American LNG is going to be ferocious, and the Iran war has strengthened that argument significantly. At the same time, Trans Mountain Corporation, which operates the expanded oil pipeline system that now moves approximately 890 barrels per day from Alberta to BC's Pacific Coast after tripling its original capacity, is actively pursuing another throughput increase. Using drag reduction agents and additional pumping capacity, the company has outlined a pathway to approximately 1.2 million barrels per day by around 2029. That represents 34% more capacity than the current expanded system. And every additional barrel unlocked means more Canadian oil reaching international buyers at better prices. And then came the deal that no one had on their calendar. On May 28, 2026, Canada announced a landmark energy agreement with Germany described by multiple sources as the first of its kind between Canada and Europe. Under the agreement, Germany's state-owned energy company SEF, which stands for Securing Energy for Europe, will purchase 1 million metric tons of LNG annually from the proposed Qatar Lisem's LNG project in British Columbia. Deliveries are expected to begin in the early 2030s and continue for up to 20 years. The Qatar Lisem's facility, developed through a partnership between Western LNG, Rockies LNG Partners, and the Nisga'a Nation, is designed to export up to 12 million tons of LNG per year from its location approximately 80 kilometers north of Prince Rupert. If completed, it would become Canada's second-largest LNG export terminal after LNG Canada. Shell and Total Energies have already each signed separate agreements to purchase 2 million tons per year from the facility, together accounting for roughly one-third of its planned capacity. The CFE deal adds a major European anchor buyer to that picture. German officials have been searching for long-term supply alternatives since Russia's invasion of Ukraine fundamentally changed Europe's energy security calculation. Canada's combination of enormous reserves, Pacific and Atlantic coast export options, stable governance, strong rule of law, and existing infrastructure now positions it as one of the most compelling answers to that search. Taken individually, each of these developments is significant. Taken together, they describe something more consequential. Canada is in the process of repositioning itself as a central node in global energy supply chains, not because it decided to try, but because the world's supply disruptions are making it necessary. The war in Iran has tightened global oil and gas markets in ways that are reshaping buyer behavior across Asia and Europe. South Korean officials have been described as actively seeking any available source of stable gas supply. LNG Canada has already sent cargoes to Japan, South Korea, and the Philippines within weeks of ramping output. The Iran war is not an external factor that happens to affect Canada. It is one of the direct forces accelerating the investment decisions being made by Shell, Enbridge, and the governments of Canada, BC, and Germany simultaneously. That said, this story comes with serious tensions that are real and worth understanding honestly. environmental groups have challenged several of the LNG projects in British Columbia, arguing that accelerating fossil fuel development undermines Canada's climate commitments. The Ksai Lisem's project faces separate federal lawsuits from the Lax Kw'alaams Band and the Metlakatla First Nation, and lacks consent from nearly half the indigenous groups consulted during the provincial review process. Critics point out that the expanded West Coast pipeline alone could add roughly 6 million tons of CO2 equivalent annually. Inside Prime Minister Carney's own Liberal Party, former Environment Minister Stephen Guilbeault announced he would leave caucus over the direction of energy policy. These are not fringe objections. They represent genuine, unresolved tensions between energy security ambitions and climate commitments that Canada has not yet found a way to square. The economics are also not without risk. The Ksai Lisem's project is estimated to cost approximately $26 billion, nearly 3 times original projections. The project still lacks a final investment decision and has struggled to fill its remaining capacity commitments. LNG markets, while currently tight because of geopolitical disruptions, are projected by some analysts to face oversupply pressure later this decade as multiple new export projects come online globally. What is beyond dispute, however, is the direction of the capital flows. Shell committing $22 billion, Enbridge committing $4 billion, Germany signing a 20-year supply agreement, Trans Mountain planning to push toward 1.2 million barrels per day. These are not exploratory conversations. These are binding commitments made by sophisticated institutions that have modeled the economics carefully and concluded that Canadian energy has a long, valuable future in front of it. Canada spent a decade watching infrastructure bottlenecks, regulatory uncertainty, and political friction limit its ability to translate enormous resource wealth into global market share. The resource base was always there. The demand was always building. What was missing was the infrastructure, the political alignment, and the global conditions that made the economics undeniable. In 2026, all 3 of those ingredients are arriving at the same time. This is Global Sketch. Drop your thoughts in the comments. We want to know how you are reading this energy shift and which piece of the puzzle you think matters most. Subscribe now so you don't miss our next breakdown. The Canadian energy story is moving fast, and so are we.